are going to have a harder time now that there's so many of them competing for a diminished bunch of opportunities. So my advice to value investors is to get used to making less.
Charlie has been telling me the same thing the whole time we've known each other. I mean, we get along wonderfully because...
So we are making less.
Warren Buffett, the Oracle of Omaha, believes the current market situation is worse than 2008. Could we be on the brink of another financial meltdown? In this video, we'll look into Warren Buffett's recent warnings, comparing today's market conditions with the pre-2008 era, and explore what this means for your investments. We'll also uncover the speculative behavior driving this bubble, how it mirrors past crises, and what steps you can take to protect your portfolio. Stick around because at the end, I'll reveal a critical strategy to navigate through these turbulent times. We're witnessing a significant market bubble today, reminiscent of the pre-2008 era. Back then, real estate prices soared, driven by speculative investments and risky lending practices. Fast forward to today, and we see similar patterns in various markets, from real estate to tech stocks. According to Buffett, the warning signs are clear: excessive leverage, speculative investments, and overvalued assets. In the US, home prices have increased by over 20% in the past couple of years alone. Cities like Phoenix and Austin have seen prices surge by more than 30%. The Case-Shiller U.S. National Home Price Index, which measures changes in the value of residential real estate, recently reported its highest year-over-year gains since its inception. This rapid appreciation is unsustainable and eerily similar to the mid-2000s housing bubble. Looking beyond real estate, the stock market has also shown signs of overheating. The S&P 500 has nearly doubled from its March 2020 lows, driven by unprecedented levels of speculative trading. Companies like Tesla have seen their stock prices soar to astronomical levels, with price-to-earnings ratios far exceeding historical norms. Tesla's PE ratio currently stands at over 1,000, compared to the S&P 500 average of around 25. This kind of speculative fervor is unsustainable and often precedes significant market corrections. Cryptocurrencies have also been caught in the speculative frenzy. Bitcoin, for example, saw its price skyrocket from around $5,000 in March 2020 to nearly $65,000 in April 2021. This meteoric rise was driven by a combination of institutional adoption, retail investor enthusiasm, and speculative trading. However, Bitcoin has since experienced significant volatility, with its price dropping by over 50% in a matter of weeks. This level of volatility is a hallmark of speculative bubbles. Another area of concern is the surge in margin debt, which refers to the amount of money investors borrow to buy securities. According to the Financial Industry Regulatory Authority, or FINRA, margin debt reached an all-time high of $822 billion in 2021. This is a clear sign that investors are taking on excessive risk, using borrowed money to fuel their trades. In comparison, margin debt peaked at around $400 billion just before the 2008 financial crisis. The doubling of margin debt within such a short period indicates a highly leveraged and risky market environment. SPACs, or Special Purpose Acquisition Companies, are another red flag. These blank check companies raise capital through IPOs to acquire private firms. In 2020 alone, SPACs raised over $83 billion, a sharp increase from the $13 billion raised in 2019. This surge in SPAC activity reflects speculative behavior, as many of these acquisitions are based on lofty projections rather than solid fundamentals. Meanwhile, retail investor behavior has changed dramatically. Platforms like Robinhood have democratized trading, attracting millions of new investors. This influx has led to a heightened market volatility, as inexperienced traders chase quick profits. The GameStop saga, where retail investors caused a massive short squeeze, exemplifies this trend. At its peak, GameStop's stock price surged over 1,700%, fueled by speculative trading. In the bond market, yields remain historically low, pushing investors towards riskier assets in search of higher returns. The 10-year U.S. Treasury yield hovered around 1.5% in 2021, far below the historical average of about 4.3%. This low-yield environment encourages speculative behavior, as investors take on more risk to achieve desired returns. Warren Buffett's warnings resonate loudly in this context. Excessive leverage, speculative investments, and overvalued assets are clear indicators of a market bubble. Whether it's soaring real estate prices, sky-high stock valuations, or volatile cryptocurrencies, today's market conditions mirror those that preceded the 2008 financial crisis. During the 2006 Berkshire Hathaway annual meeting, Warren Buffett warned about the dangers of speculative real estate investments. He highlighted how extreme leverage and greed among investors could lead to a market implosion. Fast forward to today, and Buffett's words resonate more than ever. Speculative funding methods have surged, mirroring the risky behavior of the past. One clear example is the rise of buy now, pay later services, which have exploded in popularity. Companies like Affirm and Klarna offer these services, allowing consumers to finance purchases with minimal initial payments. While this can boost spending in the short term, it also encourages consumers to take on more debt than they can manage, echoing the subprime mortgage crisis. Investors are pouring money into high-risk ventures, hoping for quick returns. The IPO market, for example, has seen a record number of new listings. In 2021, over 1,000 companies went public, raising more than $300 billion. Many of these IPOs, however, have struggled to maintain their initial valuations. Rivian, an electric vehicle startup, saw its stock price drop by over 50% within months of its IPO, highlighting the speculative nature of many recent market entries. The real estate market is another area where speculation is rampant. Institutional investors, such as private equity firms and hedge funds, have been buying up residential properties at unprecedented rates. In 2021, institutional investors purchased nearly 1 in 7 homes sold in America's top metropolitan areas. These investors often use leverage to finance these purchases, driving up prices and pushing out first-time home buyers. This speculative activity has contributed to the rapid increase in home prices, creating an unsustainable market dynamic. Cryptocurrency markets are also rife with speculation. Beyond Bitcoin, numerous alternative cryptocurrencies, or altcoins, have experienced dramatic price swings. Dogecoin, originally created as a joke, surged over 12,000% in 2021, only to crash spectacularly. This kind of speculative trading is driven by social media hype and the fear of missing out, rather than any fundamental value. Margin trading has become increasingly popular among retail investors. Platforms like Robinhood have made it easier than ever for individual investors to trade on margin, borrowing money to amplify their positions. While this can lead to substantial gains in the rising market, it can also increase the risk of significant losses if the market turns. The increased use of margin trading is a worrying sign of speculative excess in today's market. Buffett has often spoken about the dangers of following the crowd. He emphasizes the importance of fundamental analysis and long-term investing over short-term speculation. In today's market, however, many investors are ignoring these principles, chasing quick profits instead. This behavior is evident in the meme stock phenomenon, where companies like AMC and GameStop saw their stock prices skyrocket due to coordinated buying by retail investors on platforms like Reddit. While some early investors made significant gains, many others were left holding overvalued stocks that quickly lost value. Speculative investments are not limited to stocks and real estate. The art market has also seen a surge in speculative activity. Non-fungible tokens, or NFTs, have become a hot commodity, with digital artwork selling for millions of dollars. In March 2021, an NFT by the artist Beeple sold for $69 million at a Christie's auction. This speculative fervor in the art market is reminiscent of the dot-com bubble, where investors poured money into internet startups with little regard for their long-term viability. Buffett's warnings about speculation are more relevant than ever. The surge in speculative investments, driven by leverage and the pursuit of quick profits, mirrors the behavior that led to the 2008 financial crisis. Whether it's real estate, stocks, cryptocurrencies, or art, the speculative bubble continues to grow, setting the stage for potential market turmoil. Warren Buffett often emphasizes the dangers of dumb lending.
58 years we've been running Berkshire. I would say there's been a great increase in the number people doing dumb things, and they do big dumb things. And the reason they do it to some extent is because they can get money from other people so much easier than when we started. So if that's done on a large scale, which it couldn't be done 58 years ago, you couldn't get the money to do some of the dumb things that we wanted to do, fortunately. So I think that investing has disappeared so much from this huge capitalistic market that anybody can play in, but that the big money is in selling other people ideas. It isn't outperforming.
So, before the 2008 crash, lenders extended credit recklessly, leading to the collapse of the housing market. Today, we see a similar trend. According to recent reports, non-bank lenders are approving loans at unprecedented rates, often without adequate checks on borrowers' ability to repay. In 2008, the reckless lending practices of banks and financial institutions led to the subprime mortgage crisis. Lenders offered loans to individuals with poor credit histories, resulting in a wave of defaults when these borrowers couldn't meet their mortgage payments. This scenario is repeating itself in different forms today. Non-bank lenders, which now make up over 50% of the mortgage market, are issuing loans with relaxed standards. This surge in risky lending is creating a fragile financial environment. Charlie Munger, Buffett's longtime partner, also pointed out how such lending practices create an epidemic of bad credit, setting the stage for a financial disaster. One example is the rise of the alternative lending platforms that offer high-interest loans to subprime borrowers. These platforms often use automated systems to approve loans, bypassing traditional credit checks and increasing the risk of default. The auto loan market is another area of concern. According to the Federal Reserve, the total amount of auto loan debt in the U.S. reached $1.37 trillion in 2021, with a significant portion of these loans going to subprime borrowers. The delinquency rate for auto loans has also been rising, indicating that many borrowers are struggling to meet their payments. Buffett's concerns about dumb lending are not limited to the housing and auto markets. Corporate debt levels have also surged, with companies taking on massive amounts of debt to finance stock buybacks and dividends. According to the Institute of International Finance, global corporate debt reached a record of $86 trillion in 2021. This high level of indebtedness makes companies vulnerable to economic downturns and increases the risk of defaults. Buffett's warning is clear. Reckless lending practices can lead to catastrophic consequences. The surge in non-bank lending, relaxed loan standards, and rising levels of subprime debt are all red flags that echo the conditions preceding the 2008 financial crisis. So, what can you do to protect your investments in these turbulent times? Warren Buffett advises maintaining a conservative approach. Focus on assets with strong fundamentals and avoid speculative investments. Diversification is key. Spreading your investments across different asset classes can help mitigate risks. Additionally, keeping a portion of your portfolio in cash or cash equivalents can provide a safety net during market downturns. This strategy has helped Buffett navigate through various market crises and can be a valuable tool for individual investors as well. Buffett also emphasizes the importance of patience and discipline. Avoid the temptation to chase quick profits in speculative markets. Instead, invest in quality companies with solid long-term prospects. By following Buffett's advice and staying focused on fundamentals, you can better protect your investments and navigate through market volatility. By understanding the parallels between now and the pre-2008 era, we can better prepare for potential downturns. Conservative investing and avoiding speculative behavior are essential to protecting your wealth. What are your thoughts on the current market conditions? Do you think we're heading for another crash? Share your thoughts in the comments below. And if you found this video helpful, don't forget to like and subscribe for more insights from the world's greatest investors.